So, hello everyone and good evening. On behalf of the Arun Duggal Centre for ESG Research, I extend a warm welcome to all of you to this very interesting webinar presented by Ms. Namita Vikas. Ms. Namita Vikas is the founder and managing director of auctusESG, a global firm providing strategic advisory services on sustainable finance, climate transition, ESG, and climate risk management. In her previous leadership role at Yes Bank, she led the issuance of one of the first green bonds offered by Yes Bank and launched many innovative sustainable finance products. Since 2020, following her passion to accelerate global sustainable finance and climate transition at auctusESG, she has steered marquee global projects awarded by international governments, UN agencies, and global DFIs in emerging markets like Latin America, Central Asia, Southeast Asia, India, and Africa. She also continues to be a member of several expert committees on sustainable finance and ESG, including those by the Government of India and the ISO. Currently, she also serves on the Global Advisory Board of Climate Bonds Initiative UK, the Finance Industry Advisory Board of the IEA, which is the International Energy Agency, and Digital Green USA. So I again welcome all of you and Namita to this webinar. Before we start, I will just lay down the rules for the webinar. So we will let Ms. Namita complete her presentation and then we will pose our questions. And if a question pops up in your mind even during the presentation, please put it in the chat box and then we will pose it to our speaker today. Okay, fine. So without much delay, I will hand over the stage to Ms. Namita. So welcome.
Thank you. Thank you very much, Professor Desai. Good afternoon to everybody who's joined in today at this webinar. Very happy to be a part of this session discussing the current preparedness of the banking sector on ESG and climate risks with a particular context to India. So to just begin, I think it's very important to understand that no country today is immune to the impacts of climate change. I'm sure you all have realized that. Unchecked, climate change will push over 132 million people back into poverty over the next 10 years, undoing all the hard-won developmental gains that I've had so far. So, looking at all of that globally over the past 18 to 24 months, there has been an increased focus on climate responsibility, and especially by financial institutions, given that they are all public trust institutions and play a very central role in an economy. They have to be very, very mindful of how they deploy the capital. And therefore, there has been a hard focus on financial institutions, particularly from the regulatory standpoint and the investor-led developments. And because of these global pressures, India too has witnessed a cascading effect. Boardrooms, management corridors, employee base across banking and corporate sectors have started to talk about ESG and climate risk. So that's really the backdrop on which we will start. So next slide, please. If we, climate crisis is becoming a financial crisis. And I think that's very important to understand. Climate change is already having financial consequences for financial institutions. So if you take an example of the US insurance sector, not being able to bear the rising costs of climate risks are restricting certain coverages or pulling out of some areas, making it impossible for businesses to get insurance covers or pay almost quadruple insurance premiums. So what we are seeing is that risk patterns are occurring simultaneously, given the underlying connection between ESG, climate risks, and financial risks. A report that was released by the US Financial Stability Oversight Council sought to identify and respond to vulnerabilities in the American financial system, and these are replicable across geographies. So as we see how climate change has led to abrupt and unpredictable shocks to the global economic or financial conditions, now this is bound to diminish the ability of financial systems to provide services, including the provision of liquidity or availability of credit. And the figure on the slide that we have put out, this is adapted from the FSOC's report, and that really demonstrates the transmission channels that link climate risks to the economy and financial sector. So as you can see, climate risks, also ESG risks, are likely to affect households, communities, companies, governments, in a sense, all stakeholders, leading to, say, damages on property, interruption in business activities, negative impacts on companies or household incomes, ultimately altering the value of assets and liabilities. So if you look at an example, the rising sea levels and the higher incidences of extreme weather events are causing losses for, say, homeowners, for example, and diminishing the property values, leading to greater risks in mortgage portfolios. Live example is Mumbai, that's likely to be submerged by the mid-century, and many Indian cities for that matter. And many a times, such factors are not taken into consideration by lenders. And then what happens is, as a result of such outcomes, the financial sector as a whole is likely to experience increasing credit and market risks associated with, say, loss of income, defaults and changes in asset values, liquidity risks associated with the changing demand for liquidity, operational risks linked to disruptions in infrastructure or other channels, and at times legal fines or fees or other kinds of implications. So all of these are likely to be amplified through correlated exposures. And these outcomes can cause financial institutions to withdraw credit provisions or other financial services, like I mentioned the US example, which may further amplify the initial shocks brought by climate change, as suggested in this particular diagram that we put out. And then there's a possibility that these effects create a kind of a feedback loop where withdrawing credit could further lead to barriers in mitigating or adapting to climate change, resulting in greater impacts on the broader economy. So I just wanted to put that out so that you are aware about how climate crisis is a financial crisis potentially. Next slide, please. Let's very quickly understand some of the global developments, the unique nature of ESG and climate risks, and how this would translate to financial risks, and look at what is happening in the global space, right? I would just talk about how the new evolving role of banks worldwide. So if we can go to the next slide, please. Let's just look at a little bit of historic data. 1972, the UN Conference on Human Environment, that was really the evolution of climate change, where multi-actors, government, private sector, NGOs, all of them came together to focus on human interactions with the environment. In 1987, the Brundtland Commission coined and defined sustainable development. So that's when this phrase came up. In 1992, we saw the Rio Earth Summit, and then the institutionalization or the formation of the UN Environment Finance Initiative, that's the UNEP-FI, that was formed in 1992, and it became the foremost platform to engage the finance sector on sustainability. It eventually released the principles of responsible investment, principles of responsible banking, as well as insurance. Then in 1997, we saw the Kyoto Protocol that was adapted and linked to the UNFCCC. And then if you come fast forward to 2015, the landmark Paris Agreement, which all of us hear today about, where 190 countries signed commitments at country level objectives or targets, basically, to combat climate change. Of course, the SDG framework evolving 17 sustainable development goals and the targets to be met by 2030, that also came up around the same time. Now in 2017, particularly the Financial Stability Board came out with climate-related financial disclosure standards, which was the task force of climate-related financial disclosures, and that's fast becoming the mandatory framework in many developed markets, and some emerging economies are also putting that up. I think formation of the Network for Greening the Financial System, as known as NGFS, a group of central banks and supervisors came together in 2017 to define and promote best practices that contribute to the development of environment and climate risk management in the finance sector. We saw how the UN COP26 that was held in Glasgow identified major roles in mobilizing finance. I think that was one of the first times when finance as an agenda was put forward. It became a priority in correlation to climate action. And then at COP27 last November, the historic announcement of loss and damage fund that was made. Particularly, this was for vulnerable countries which are more and more vulnerable to climate change. I think this was a very important step towards plugging the shortfall in climate adaptation financial flows. And I think another major development that one must look at is the consolidation of multiple ESG disclosure frameworks by various standard setting organizations. All of them decided to come together and talk about how disclosures should be standardized. And finally, I think a significant step in the banking sector, so to say, was in 2022, when the Basel Committee on Banking Supervision brought out 18 principles for effective management and supervision of climate-related financial risks. So overall, if you see at a global level, there has been significant progress in the last 2 to 3 years. I wouldn't say the last decade, but the momentum has built on sustainability, on ESG, and on climate action. Next slide, please. I wanted to just show very quickly what market trends are and how the financial world has accelerated this whole, within the space with world's largest transition to net zero. Look at the ESG, look at the sustainable finance, and all this has got turbocharged with investors looking at this or prioritizing this as an agenda. In 2021, the Glasgow Financial Alliance for Net Zero, that's like the father of all net zero alliances in the finance sector, was formed. That was supported by 550 members, that is 550 institutions, financial institutions across 50 countries, to set a very meaningful decarbonization commitments and to overall accelerate the transition to a net zero global economy. And apart from that, there are many other global initiatives like the RE100, the Climate Action 100, that has brought the world's influential businesses to look at driving a very ambitious agenda as far as climate is concerned. But I think, it was Larry Fink, the BlackRock CEO, who set the stage ablaze, if I may put, when he went public in his 2020 annual report to his shareholders and to CEOs, calling for capital reallocation towards sustainable and ESG strategies on account of the growing climate risks. So that was really, that set the momentum within the investor community. If you look at the regulatory guidance on the screen, in a way, market trends have actually fueled fueled these regulatory developments. And if we look at the principles of effective climate risk management and supervision that was released by the Basel Committee on Banking Supervision in June 2022, I think that really brought the finance sector to sit up and look at climate risks in a way. And, given that, if you look at India, given that RBI takes a greater interest in managing climate risks, a likely alignment of Indian banks and financial institutions to the Basel Committee principles in some way, if not entirely, is also a possibility. So these are 18 principles, 12 for banks and 6 for supervisors. And these really seek to provide guidance on effective management of climate risks, cover areas like corporate governance, internal controls framework, capital and liquid adequacy, and risk management processes. Then, if you look at Europe, the EU taxonomy that really picked up pace, and it's a common classification system for low carbon, resilient, and resource efficiency activities that businesses align with to achieve sustainability goals. It is applicable across all businesses, including FIs in the EU. I think one important one that I want to mention here is the EU carbon border adjustment mechanism. It was in the newspapers, even in India, over the last month. And that is a kind of a guideline or a mandate that levies tariff on imported goods across specific sectors. The CBAM, as it is called, will be implemented in phases from October 2023. between October 2023 and December 2025 is the transitional period, and it will become fully operational and mandatory, where all those who manufacture goods outside of Europe will, if basis their carbon emissions, will have to pay a particular tax. Now, both the taxonomy, EU taxonomy, and the Carbon Border Adjustment Tax has, started to impact European companies, foreign entities which are engaging with European markets. So India has also taken note of it, and there are a lot of discussions around how India is going to get covered under the, especially the steel and cement sector. Then I think, the SFDR, that is a Sustainable Finance Disclosure Regulation, applies to financial firms like asset managers, banks, financial advisors, pension funds, insurers. It is a set of rules that aim to make sustainability profile of funds more comparable and better understood by end investors. UK, on the other hand, being the first G20 country, has mandated the TCFD disclosures, that is the Task Force on Climate-Related Disclosures that I earlier spoke about. If you look at the US SEC, they have announced creation of Climate and ESG Task Force to identify any material gaps or misstatements in issuer disclosures of climate risks under their existing rules. Many other regulators, the Singapore Stock Exchange, the Hong Kong Stock Exchange, in Malaysia, you have the Bank Negara. All of them are putting certain mandatory disclosures or certain rules around this. So regulation is really aiming to enhance the role of financial systems to manage risks and to mobilize capital for green or low carbon investments. And if you look at this regulatory push, we're seeing that in India also. India's BRSR, Business Responsibility and Sustainability Reporting Guidelines, or the Green Retail Deposit Guidelines that the RBI issued, or the discussion on climate risk management in Indian banks, the rules for ESG rating agencies. I think all of this is somewhere creating or making that stage really for Indian banks and Indian entities to align as far as this area is concerned. Next slide, please. A very quick look at the taxonomies. What are taxonomies? Taxonomies are really the definition of sustainable finance that aims to be a kind of a comprehensive classification system, a clear guidance as to whether an asset can be considered sustainable or not, and how is it key in achieving the net zero targets. From the map, you can see that there's immense traction that has been picked up across geographies. If, in fact, in India, the Ministry of Finance, did get a draft of the sustainable finance taxonomy, and they should soon be releasing it. SEBI has already put out the revised green bond guidelines in February 2023. There is an updated definition of what constitutes green. There is also, in a way, all regulators are looking to prevent greenwashing to some degree. So that's really how the regulations are working in that sense. Next slide, please. I want to quickly show you a trend of how sustainable finance has emerged, specifically sustainable debt, which recorded a cumulative issuance of $3.9 trillion since 2006 to date. Green bonds form a majority of this total, as climate concerns have to come to the fore, or that have come to the fore for a decade now. GSS, that is green, social and sustainable bonds, provide investors with an ability to finance environmental and socially impactful projects while securing about the same risk or return profile of conventional bonds. By 2022, GSS issuances had crossed $850 billion. Of this, again, 50% is green bond issuances, very similar to the cumulative issuances trend. The majority of the bonds in social and sustainability category are issued by government-backed entities or developmental banks and financial corporations, while the green theme specifically green, over 50% of the green volumes are by private sector, which have been led by, some have been led by financial corporations. I think if you look at also the ESG oriented investing assets, these also shot up as much as 3 times in assets across 5 major markets to reach about $35.3 trillion in 2020 from a 13.6 trillion in 2012. And the recent forecast suggests that the ESG oriented assets could exceed 53 trillion US dollars by 2025, which is representing more than a third of the projected total AUM. Next slide. So that's really about the global developments of what's happening globally. Let's quickly jump into what's happening as far as India is concerned. Well, until recently, developments were focused more on reporting and disclosures. In India, discussions around sustainability started way back in 2007 when RBI first indicated this in a circular that it sent out to banks. 2011, the Ministry of Corporate Affairs brought in the National Voluntary Guidelines, followed by the Business Responsibility Report requirements in 2012. Further, that got strengthened in 2021 with SEBI announcing the BRSR requirements, which are applicable to top 1,000 listed companies, which has become mandatory from this year in terms of the reporting. Now, BRSR is very unique in that sense because it's kinds of material ESG risks and opportunities and approach to mitigate or adapt these risks. On green financing, SEBI also brought out the the framework for green debt securities in 2017, which was updated in 2023. RBI also joined the NGFS in 2021, which is a kind of an important step for the Indian banking sector in terms of a kind of an intent signaling that it needs to look at all these aspects. And then discussions on climate-related financial risks came to the fore when last year RBI brought out a discussion paper on climate risks that mapped out areas like climate-related governance, strategy, risk management, disclosures, and capacity building for Indian banks. In 2023, progressive regulations and guidance from both RBI and SEBI in various ways has come out. So revised disclosure requirements for green bond issuances by SEBI that in a way has brought in deeper emphasis on transparency and global best practices. Another important step was within the green bond framework, there was an inclusion of blue bonds, yellow bonds, and transition bonds. And then, as I said, the green deposit framework, I think that was very, very important. So if you look at this overall space, there's a lot of action when it comes to the Indian, how the Indian government and banks are looking at it. So in short, regulators both globally as well as in India are increasingly leaning towards increased levels of non-financial disclosures, and banks will therefore have to shift course to align with these requirements faster than anticipated. Let's go to the next slide. If you look at sustainable finance instruments in India, since I showed you the global landscape, at a sovereign level, the sustainable debt market in India has been gaining momentum. In APAC region, India is the 6th largest issuer of green, social, sustainability linked or transition bonds. The cumulative volume of GSS bonds has been about $19 billion as of 2021. Out of this, almost 18 billion were issued in form of green bonds, mainly by renewable energy companies. Despite India's successful sovereign green bond issuance, the overall market is really muted right now. Corporate issuances are seen, but concentrate very much within the renewable energy sector. Commercial banks need to step up because that's where the scale will come in. But maybe the extra cost of green finance or lack of demand or dearth of investors in the green bond space may have kept banks at bay. On the equity side, there are about 10 ESG equity funds managed. Assets would be about INR 10,200 crores. And it is predicted that there is, the ESG themed investment is going to surge, will account for almost 30% of the overall fund volume and reach over 270 billion US dollars by 2030. Announcements by SEBI to boost ESG investing through mutual funds, ESG rating norms, transition bond guidelines, all of this is bound to widen the investable universe for ESG and open doors for Indian investors to invest in funds that are consciously adopting. Let's go to the next slide and look at how integration of sustainable finance and ESG is happening within banking products. So if you look at this slide, green finance has emerged both at the retail as well as the wholesale level within assets and liabilities. So instruments like green bonds have provided, and since 2015, Exim Bank, Yes Bank, Axis, IDBI, SBI, they've all issued green bonds. Then another category, sustainability linked loans, which are structured very similar to green bonds, but are general purpose loans that incentivize borrowers' achievement of predetermined sustainability targets against a particular matrix. So Union Bank and SBI have issued LLLs integrating KPIs into financing and demonstrating commitment to sustainability goals. On the green retail liability product side, these are designed for retail customers whose deposits are used as proceeds to finance green projects. With the recent green deposit framework by RBI, I think that serves as a guideline to bring in some kind of standardization and a level playing field within this segment. As retail deposits are the lowest cost of funds for banks, I think this kind of a framework would really help build the scale in low cost green capital. And many have also created an attractive basket of incentives. So, for pulling in depositors. So for example, one of the first green deposits that was structured by Yes Bank, it involved a higher rate of interest, a commitment to deploy deposits to green financing, promoting paperless transaction and planting of trees on behalf of the depositors. It built a lot of good traction. If we move on to the wholesale side, green term loans are for emission reduction projects such as captive renewable energy, energy efficiency, green buildings, construction, or transition to low carbon projects. A very good example here is a green term loan of INR 500 crores by Bank of India to NTPC's Renewable Energy Limited, that's the company, for the company's 2 solar projects. So, developed markets have also seen products like green guarantees or standby letters of credit, wherein banks are providing guarantees on underlying projects that contribute positively to the environment. And finally, on green retail asset products, the most common products within the Indian banking sector, and you may have also heard, you may have also taken these kind of loans, and that is the green car loan and the green home loan. So these are typically for purchase of electric vehicles and green homes, which now some of the builders are selling. So State Bank of India has a green car loan scheme, which actually gives a lower interest rate and longer repayment window for electric vehicles. So if not, please go and look at it. SBI has also a dedicated product for financing. So, including Glide, while it is seen that green and sustainable products are fast picking up in the Indian banking sector, there's a lot of potential for more innovation in this space. So, like I said, internationally, there are green guarantees, there are sustainable trade finance and transaction banking products, green securitization using asset-backed securities. All these kind of innovations need to come about in the Indian banking sector. Let's move on to look at some of the initiatives within the banking sector. So it just tells you about where Indian banks are. So from a process and an initiative perspective, there have been activities within the Indian banking sector. You can see on the screen, banks in India have started to look at ESG from a policy perspective. Banks like SBI, IndusInd, RBL, ICICI, even smaller banks like Karur Vysya Bank, they all have ENS that is environment and social, or ESG policies. For example, Federal Bank received a certificate of achievement from IFC as it disbursed about USD $332.9 million worth of climate loans, which was the largest amount in the Southeast Asia for the fiscal 2022. IndusInd bagged an ESG award for a very dedicated sustainable banking unit with a focus on ESG in business risk and operations. This means that an ESG filter is applied across commercial lending, microfinance, sustainable finance, and governance matters. So that's really what's happening in terms of initiatives in pockets. So let's go to the next slide. The key takeaways: all countries around the world are introducing increasingly stringent climate policies and ambitious net zero targets. New policies are shaping the market. Impacts of climate change are witnessed globally with rapid action to reduce emissions. We are looking at a big climate crisis, which is going to impact economic and financial parameters. Indian banks are at different stages of adopting ESG policies. However, translating that into integration within lending models and implementation is crucial. And again, that's also at different stages. So let's move on and let's look at the preparedness of Indian banks in sustainable finance and ESG and climate risk. So if we look at this slide, in January of 2022, RBI conducted a study amongst Indian banks to assess the status of climate risks and sustainable finance. The survey findings indicated that while participating banks had begun recognizing climate risks, a lot remained to be done to measure, monitor, and integrate such risks. So there's a lot of concern, but there is no competence in terms of being able to do this. Majority of public and private sector banks did not have oversight mechanisms and responsibilities for governance within ESG. On risk management, while most banks did recognize the urgency, integrating climate risk into the risk management framework was still at bay. Data, processes, and methodologies and capacities were also cited as insufficient. Overall, foreign banks fared better than public and private sector Indian banks. And the survey clearly brought out gaps across crucial pillars of climate risk management, that is governance, strategy, and risk management. If we go to the next slide, auctusESG along with ODI and climate bonds, this was a UK government project. We had initiated a landscape assessment of ESG and climate risk preparedness amongst Indian banks. This was late 2021. And if we look at the next slide, please, there were 10 participating institutions, and I thought that this was important because this was like a one-on-one survey that was undertaken. So 4 indicated that the board of directors had direct oversight of ESG and climate issues. Board level committees with oversight included CSR audit, and in one case, distinct ESG committee. Participating institutions saw relevance of ESG oversight into mainstream business decision making. A few cases had ESG under the CSR committee. However, given the lack of any kind of regulatory guidance or nudge, most banks were yet to establish any kind of dedicated ESG committees. And there were gaps in terms of this kind of expertise across the organization, which is at the senior level as well as at the board. For training, there were only 2 institutions that indicated that they had made some provisions for ESG and climate training. On executive compensation, 4 did not link any of this to the ESG performance. And on gender equity and social inclusion, 6 institutions made provisions in hiring to strengthen representation of key social groups such as women, people with disabilities, people from socially disadvantaged groups, or people from the rural areas. Next slide, please. On risk management, a sharp shortfall was seen in ESG and climate risk practices, management practices, right? So of the 10 institutions, less than half systematically identified, quantified, and used ESG and climate risk to guide financial decisions. So as you can see, the figure on the right, about 50% did not have standalone frameworks for assessing some combination of these kind of risks. Many institutions indicated that physical risks, KPIs, were not in place. Only one had KPIs such as for transition risks. Two institutions attributed this to lack of standard methodologies or any kind of regulatory guidance. And these findings do speak of the broader culture of ESG integration in risk and credit considerations, since these are leading institutions that we were looking at. If you move on to the next slide, from a strategy standpoint, 7 institutions indicated that ESG and climate considerations were integrated into their business strategies. The major motivations were reducing reputational risk and strengthening the brand, portfolio diversification and new business opportunities, safeguarding against credit risks and non-performing assets, and unlocking new or low-cost capital from very focused green funds. So if we, just one more point I want to make on financial products. Some institutions at that point of time had introduced products, but we've seen more and more product introductions that came by after 2021. Some had focus on gender equality and social inclusion. So, particularly products for women, rural businesses, youth-led businesses. I think that was evolving. Next, disclosures. ESG and climate disclosures, there were these disclosures. However, they faced two main challenges. I think one was lack of capacity to analyze and report, and then lack of data or data collection tools and understanding of the frameworks. So I think with the BRSR, there will be more, transparency. I'm sure there is more training and capacity building in these areas. So very quickly, key takeaways. Both the surveys indicate that currently there is limited uptake of ESG and climate risk when it comes to integration, despite recognition that yes, these risks are critical. The situation, like I said, may have marginally changed since the surveys were undertaken. More and more institutions have been talking about ESG and climate risk because there's so much being covered these days, given the concerns of the board of directors or the management. In some cases, regulators, representatives like the Indian Banks Association or the Indian Institution of Banking and Finance, they have started to educate banks on these aspects. However, most banks have indicated that they're waiting to see the regulatory guidance before they formulate any of their policies. Let's move on to the next slide. And that is where we will very quickly capture some of the case studies. So, global banks have started integrating climate-related financial risks into their current risk management practices. So they are a little ahead of where we are in India. And some banks have created very unique frameworks to set specific targets. I'm taking two examples here from different markets, one from Malaysia and the other one from India. So if you look at Malaysia, that is BPMB, is a leading development financial institution in Malaysia, and through its green financial services and products, it has significantly promoted sustainable finance in the country. The purpose and the strategic transformation plan of the bank aligns with that, with the developmental, so the sustainable development goals of Malaysia as a country. So there's a correlation and an integration with the country's goals, which is a very good thing because there will be a cascading effect from the country to business entities. The bank has also embedded ESG and climate aspects in both risks and opportunities within its business model. If you look at the screen, the MIND, that is measuring impact on national development assessment framework, the MIND framework that they developed. This is developed in collaboration with World Bank, and it has two-dimensional matrix that they use while lending, which incorporates about 32 indicators to assess a project's financial efficiency social and environmental and economic impact. Highly ranked projects get higher priority of lending by BPMB. On the climate risks front, the bank has evolved its own climate change risk framework, adapted from the climate change and principles-based taxonomy that was released by their own central bank. So the advantage that they have, that Bank Negara, which is the central bank of Malaysia, they already have put out certain guidance in terms of what banks need to do. They are also bank, BPMB, they adopt the three lines of defense model as suggested by the Basel. And what does that mean? Right from loan origination to disbursement to internal audits, all have risk oversight. On the governance front, BPMB board and the Sharia committee oversees banking regulations and sustainable practices. In fact, the Sharia committee is also responsible for implementing Sharia conscious governance practices into risk management, leadership, and reporting standards. If you look at the opportunity side, so what I told you was the risk side, the lending model very much focusing on impact. And as a result, there is a strong focus on infrastructure development and support to small businesses. So in 2021, the bank approved green financing of over $104 million to these kind of businesses. BPMB is also a signatory to the UN Principles of Responsible Banking, and it also uses integrated risk reporting framework for its particular disclosures. It has a AAA rating from Malaysian agencies as well as other agencies. Now, it's important to see how it has integrated the ESG and climate risk model into the business model. And that's what we really depicted here on the screen. Let's go to the Indian example now, and that is of Axis Bank. This is based on this public secondary research that we've done. Axis Bank has come up the curve very fast in the last couple of years on ESG, climate risks and opportunities. On the ESG risk management side, as you can see on this slide, it includes various aspects like ESG policy, including ESG and climate risks in their internal capital adequacy processes, assessment, capacity building. Its annual sustainability report discloses mapping of the bank's programs across various UN SDGs. The bank also taps opportunities to innovate on sustainable financing products. So recently, it signed a $150 million deal with ADB to finance MSMEs for participating in trade through environmental and socially sustainable supply chains. So under this particular facility, it's a partial guarantee facility with ADB. ADB provides partial guarantee to Axis Bank for lending to its supply chain products. Now, with a hard focus on ESG and other priority sectors, the guarantee program also covers all products, including working capital loans for MSME. So it's a very interesting, innovative product that they have put together. And the bank has also set up targets. For example, incremental financing of about 30,000 crores in INR under their wholesale banking to sectors with positive social and environmental outcomes. This target is by 2026, generating a 5% of retail electric two-wheeler loan portfolio by 2024, scaling down exposure to carbon-intensive sectors, incremental disbursement of about 10,000 crores by March 2020 workforce. So Axis Bank has also issued the country's first sustainable USD 81 notes in 2021. And the size of this issuance $600 million and was listed at India INX and NSC at the GIFT City. And the bond proceeds are used again for green and social projects. Lastly, from a governance standpoint, it has a standalone ESG committee of the board. which is chaired by an independent director. The bank has been participating in global ESG ratings like MSCI, FTSE for Good, BJSI, also disclosing on CDP. It uses the integrated reporting framework and GRI standards when it comes to its disclosures. And there have been some good practices employed by the bank on many of these fronts. So this makes a good example as an Indian case study. But I think when you compare this with some of the international banks, I think we still have a long way to go. In closing, I would say that, Indian banks are in a very good position to adapt to the changing regulations, to analyze what kind of impacts it's going to have from international regulations, to be future-proofing itself for the regulations that India is going to bring about. It needs to build more capacity within its internal teams and, move very quickly to take all this into its stride. And here, when we talk about ESG, when we talk about climate risk, this is not the 2% good to do, but it's really the 100% of making the business sustainable. So on that note, I will close this session and I'm happy to take questions.
So I think, Namita, thank you for the presentation. The first question that we have is something that you might have already partially answered, and it is about only certain private banks being part of this initiative, whereas the larger banks have typically stayed away from this. So when do you think that the larger, especially some of the nationalized bank, will start moving into this type of mindset? But because this is more a mindset about incorporating this into their lending policies and so on, right? So
thank you for that question. See, I think it's very important to at first understand that the banking sector is highly regulated as far as India is concerned, right? So banks follow regulations and they do everything within the periphery of the regulations. So at one level, because of the international pressures, because of investors demanding, there are some banks, so say private sector banks mostly would have investors who would look at these aspects. So therefore, they're asking private sector banks to adapt to some of these parameters. Public sector banks, I would say that the biggest nationalized bank, SBI, has taken it into its stride, and it may not have an ESG committee as such at the moment, but it does have green loans, and it's done very well from the product side. What we hear from most of the banks is they're waiting for the regulation, and because they want clear guidance in terms of what they need to do. See, what we've seen in India is that while India does look at international regulations, so on and so forth, but it also has an Indian way of doing things, right? Because we do need to look at the local impact. And therefore, they're really waiting to see what kind of regulation is going to emerge. And once that emerges, I think larger banks would, all banks would have to align.
Right. So we have another question.
Example, I'm sorry.
Go ahead, please.
For example, in terms of ESG rating, if you would have seen that space, there were so many ESG rating agencies mushrooming till SEBI stepped in and said that there will be a regulation where all ESG rating agencies have to be beyond a particular threshold. I think they have to be a turnover of 10 crores, and they need to also be verified. So now that there is some kind of regulation that has come in, that really eliminates all kind of greenwashing or non-standardization, if I may say. So I think that's how banks are looking at it. Yeah, sorry.
So we have another question from Roshan Gonzalez, and the question is, what is the current transition finance environment in India and the potential scope of it in the near future?
See, the scope for transition finance in India is immense. India requires some $8 trillion to move to a low carbon economy, right? And different numbers are mushrooming every day. On an annual basis, we require $3.2 million, all of that. So there is tremendous opportunity as far as transition finance is concerned. Having said that, transition finance, so what happens is within banks, I'm sure if you look at portfolios of banks and actually start asset tagging in that sense, there would be a number of capital flows that have gone towards transition finance, but they could have gone under the category of general purpose loans, because there is no category saying transition finance that anybody is tracking at the moment. Once we start tracking that, one, we would know what kind of portfolio banks already have, and the kind of potential is huge, because if you look at, what is transition finance? Transition finance is finance that flows through to brown sectors to make it less brown or green, correct? Greener, I would say. It can't be totally green. So this, if you look at hard to abate sectors, for example, steel, cement, oil and gas, the buildings, there's so much of potential. So yeah, there is potential for transition finance. It needs to be classified because it's unclassified at the moment. And once we start that, I'm sure there will be, banks would start looking at lending to those more and more.
Thank you. We have one question from one of our finance faculties, Professor Vineet Virmani, and his question is that have the equity markets rewarded financial institutions that have showed more ESG climate risk consciousness? And what is your sense of evidence on this globally or in India?
See, both globally and India, more and more investors, like I said, the moment Larry Fink, BlackRock, said that it's going to look at ESG and it's going to make ESG and climate risk a part of their investment strategy, all the other funds started to align. And if you see what's happening globally, there are funds coming together under different umbrellas to look at ESG with EU taxonomy, and particularly focus on where the funds should put in their capital, the Article 8, the Article 9, which actually says what's green, what's not green, where capital needs to flow. All the European funds have to align. And the cascading effect we will see in India, right? So yes, the answer is that there is, one is, the equity markets, those, if you even look at the MSCI ESG index versus the MSCI regular index, ESG index has outperformed the MSCI regular index. So there is merit. And with all this international pressures, especially from investors, see, I'm telling you, forget today, we are sitting in 2023. In 2012, I would get 5 minutes of FaceTime with our investors to speak about ESG. And come 2019 or 2018, I think most of the time, out of the 2 days that investors would come and meet us, I think 1.5 days it was for us to talk about what we are doing on ESG. So the whole, picture has changed. And there's a lot of mainstreaming that is happening as far as ESG is concerned.
Vineet, do you have a follow-up on this? We are trying to get you on the panel if possible, but if you have a follow-up, please do type. So Vineet, you are on the panel. You can unmute and ask your question if you want to.
Am I audible?
Yes, yes.
I was coming from the point of view of whether investors who have put money in companies, individual companies, have got more return compared to those who have put in companies which are not so ESG conscious. And you have been talking about volume and money flowing, but all that does is makes those ESG funds more expensive, bringing down the returns of the investors.
See, so the evidence of how ESG is performing, ESG funds are performing vis-a-vis regular funds is certain indexes, like I said, the MSCI. I agree that right now, because of the cost of, ESG can be expensive. But see, in case of the Indian sovereign green bond that was issued, so in certain products, there is a greenium or there is a premium, an ESG premium that issuers are also getting. So it is, see, the market is evolving right now. And one needs to really watch. There are also other pressures, right? I mean, right now, the overall market uncertainties, I mean, it's phasing out, but whatever we've seen through the last 5 months, I mean, overall investors are waiting and watching the space. But yeah, I agree that it is expensive, and it is really about what is your investment philosophy and how do you want to enter. I think it really depends on funds, each fund, I would say.
Yeah, I'm good now. Thank you, Namita. I'm good for now. Thank you, Namita.
So on a slightly different note, there is a lot of literature on CSR helping, maintain brand equity during bad times and things like that. But ESG is relatively nascent in this respect right now, till now. Yeah. Thanks, Vineet, for the questions.
Thanks, Namita.
So we have another question from our one of our PhD students, which is Shikha Khurana. Again, we are trying to see if we can get her on the panel. But her question is that the Indian government continues to focus on the coal industry. Okay, Shikha, you are on the panel. Why don't you ask the question yourself?
Thank you. My question is that for India and most of the other developing countries, there is this focus on growing the GDP, and for that, coal is considered to be important. In fact, in the Glasgow committee, India was one of the few countries to stand out and refuse to sign on that phasing out of coal. Given that, do we see that Indian banks adopting a different taxonomy as far as ESG is concerned compared to the rest of the world? And is this something that should actually be encouraged?
Well, I don't know whether it should be encouraged or not. But let me say, India is going to peak at 2050, correct? India has said that 2070 it will be carbon neutral, and by 2050 it would peak. So naturally, India would depend on coal. Now, the question is, how do we balance economic growth and sustainability? There is more. So India is also looking at investing so much more in renewable energy, correct? There are many banks that have said that they will not finance coal. And I think slowly, as we go into the next 5 years, maybe, we would have maybe the infrastructure development bank or only the public sector banks, which could look at financing the government's, requirements for coal. So that's how it would emerge, because as banks, I mean, most of the private sector banks today are not looking at financing coal. If you see the coal investments or those who are financing coal, it's limited to the public sector. And with the infrastructure bank coming up, and with, I think India would need to, because if it has to align with the global commitments, we've said phase down, right? So they've agreed on phase down. So it really needs to, as a strategy, it would need to look at how it's going to finance its coal for the next decade.
On a slightly
related, why we say that we are very hard on India, I must say one thing. There are so many coal mines in Europe that got opened up, right?
So that, yeah, agreed. And then this was a related question or a sort of a follow-up to what Shikha is talking about. Like, when we think about ESG, it needs a champion in each country, right? So how do you perceive the risk coming from some of these hardline right-wing parties, which might not be supporters of ESG? So if you think about the Republicans gaining power in the US for, let's say, the next 8 years, suddenly all ESG initiatives might go out of the window. There are other parties in in Europe also where they don't care about all of these things. So isn't that a real risk which could sort of push back implementation of effective ESG policies and affect things?
I mean, see, political risk is always there, right?
Right. So
yeah. So it is only about how real is climate crisis and how that is affecting voters. if you look at it in that sense. Right? So if you look at California wildfires is a reality. So even if we deny climate crisis and we say that there's nothing like a climate crisis and we can just live in this world, I think ultimately people are going to get affected who are going to be your voters. So somewhere there is a link between all of that, because on ground reality is that there is homelessness, loss of property, loss of money, all of that. And there's so much more burden on the government to create whatever, disaster reduction budgets that they have to put out for disasters or for these kind of climate incidences.
Okay. Fine. Thank you. We have one question. I think we are getting to the end of our time period. So we have another last question. We'll take this last question from Abhishek Gokhale. And his question is that looking at the political crisis for future, do you think the Parliament of India needs to draft a new bill with financial experts' advice on these issues?
See,
codify these things, right? Prevent people from changing it at someone's whim, something like that, right?
See, if you look at the Indian budget that was released, I mean, the union budget that was released in February this year, that had all elements of ESG, ENS at least. The G part may not have come out, but if you look at the kind of outlays that were put out, or the kind of budgeting or the focus that was there, it all had the right elements of ENS. I think somewhere the Indian government is realizing the need to put this in, and we are seeing traction. If you look at the budgets 3 years back or 4 years back, vis-a-vis what we are seeing now. So yeah, I mean, hardwiring this as a part of the constitution, I mean, great. That we are able to do that. But see, our constitution also somewhere covers the social elements, right? It may not have the environmental elements, but India conventionally is a very socially oriented kind of a country, right? I mean, even if you look at CSR, we always believed in karma and doing good, and therefore you should, always give 1/4 of your whatever income towards the society. I mean, that was always there. So it's about how do we hardwire it. At least what I see is that there is political will to be able to move these aspects, and that's the good part, if I may say. See, the larger point is, it is not about, we always said, when I was a part of the bank, bankers said that we don't want it to be a law because then it becomes a tick box exercise. It shouldn't be a tick box exercise. It has to be a part of the ethos or the part of your business case. So the moment when banks or businesses start realizing that this is going to add to my bottom line, I think that's where everybody is going to start implementing on it. And that's really the point where we need to reach. Some have started to make it a business case because they're seeing value. And some, just a very small example, I'm sorry. When we issued the green deposit way back in 2018, I think, we all know that the depositors' money that comes into the bank, that's the lowest cost of funds, right? Within 52 days, we collected 3,500 crores. Now, isn't that a business case? I mean, 3,500 crores at that time, some 7% interest, where onward lending would be anywhere upwards of 40% rate of interest, right? So I think you have to just fit that into the business case and do the good part.
Thank you. Thank you. So my co-chair at the ESG Center has also joined us. Hi, Anish, if you can hear us.
Hi, Naman. Hello, Namita. Thank you so much.
Hi.
Wonderful talk. I was just sitting here because I was, also with a student in another meeting. So I kept my camera off. But,
right. So any parting questions, Anish, from your side? Or
Yeah, no, you guys have asked all in important and interesting, especially critical questions. So Namita, when we do this webinars, at least this is a tradition that we look at the critical elements of whatever we are presenting. It's the advocacy part is always there. The speaker is there to sort of, given their expertise and background, it's likely that they will be advocating the case. But we would, at least the Q&A session, we want to focus more on the critical aspects of it. And thank you, Naman, Vineet, and everyone else to have taken that up. I have nothing more to add, actually. Yeah.
Okay, so thank you, Namita, for giving this wonderful presentation and spending time with us. And with this, we will end the webinar. So thank you to all the attendees for making this webinar a success. And we hope to see you in future webinars hosted by the ESG Center. Okay, so thank you.
Thank you very much. Thank you. Bye-bye.